everybody. It's Edgardo Valentine here. I'm with Scott.
Scott DeGregorio. What's up, people?
So, what's going on,
Dude,
man?
we got to talk about the Fed today, man.
Yes.
I got to be honest. I'm pissed off.
We really have to debrief what happened.
Look,
because there's a lot of misunderstanding out there, and yeah, I mean people don't really understand how that actually affects rates. So what happened to the Fed?
I'm pissed off. So it's absurd to me that reporters are reporting that the Fed's rate cut has dropped mortgage rates. I mean, if you're going to have the responsibility of reporting something, please take some time and actually understand how economics works.
Right.
Because the Fed directly can't drop mortgage rates.
Right. So the Fed got together last week, a couple of days ago. And they went ahead and cut the rates 0.25%, which was highly expected.
100%.
Right? It wasn't a surprise. Not only wasn't a surprise that they were going to cut rates, but it wasn't a surprise that we knew exactly how much
they were going to cut.
A couple people were saying
we talked about it over the last week or so. We knew it.
So that wasn't a surprise. So what we've been communicating to people is a couple things. Number one, that the Fed rates doesn't affect directly the mortgage rates. Those are two different things.
So let's break that down. Okay. So when the Fed cuts rates, what they're cutting is what's called the Fed funds rate. The Fed funds rate is the rate that the government charges to banks for overnight lending.
So that's going to affect very short-term debt.
Right. Now,
credit cards.
The prime rates, which could impact your home equity line of credit.
Home equity lines of credit. Even adjustable rate mortgages.
In some instances, yes. But not mortgage rates.
And it makes sense, right?
Right.
And I've done a couple of videos about this, but it makes sense. When you're talking about a mortgage, we're talking about a long-term debt. We're talking about 15 years, 30 years, right? And this interest rate is not going to be affected by that short-term rate. It's going to be affected by the economy. It's going to be affected by the markets, and especially by inflation.
Right.
When you have a rate of return, the same rate of return. If I say, hey, you're going to give me the same amount of rate of return at 3% or at 4%, for 30 years or for 15 years, I really need to take into consideration what money is going to be worth in 2 years, in 3 years, in 5 years. Right? And if it's going to be less, well, then I need to bring that rate higher. If it's going to be more, then
whatever.
Fine.
But whatever. So now, although their actual rate cut doesn't mean crap, there are things that come into play. So let's start to break some of this down, because what does affect long-term mortgage rates is the overall strength and stability of the economy. And this is why people like us that know what we're doing, we don't watch what the Fed does. We listen to what the Fed says.
And how the markets react to that.
Exactly. Now, and again, you can anticipate this. So this particular time, what the Fed said was, we are not anticipating any additional rate cuts for the rest of this year. That speaks to a position of stability for the economy. Anything the Fed says that speaks to stability of the economy causes interest rates in many cases to go up, not down, which is why short term, in both of the last Fed rate cuts, mortgage rates went up initially.
Right. Okay?
And so and then what's confusing
and vice versa. The last time that they brought the rate up, the mortgage rates went down.
So, it's frustrating and frankly misleading when, I put on the Today Show or CNN or any of these other mainstream news programs, and everybody's saying, hey, now's a great time to refinance and buy a house because the Fed cut mortgage rates again.
Right.
Like, it's just wrong. And I don't know about you, but I've had client after client like, hey, what's my new rate? Hey, what's my new rate?
And the problem with that is look, when you have the expectation that now the rate overnight is 0.25% lower, the actual mortgage rate, then the amazing rate that we have right now, which is already very low compared to last year, a couple of years ago, seem like it's not as low. It seems a little higher. So you're setting yourself up for failure.
Right.
Because people are thinking that the rate should be extremely, extremely low, like 2% or like 1.5% or something like that. And then when they're getting hit with their 3% or whatever, then they are confused. They don't understand what happened, and the problem is that the communication that most people are having with them, like you say, the media and all that, is that rates overnight went down 0.25%.
And look, let's bolster that with the rest of the bullshit that's out there online, because you hear that on TV. What do? Most people, if you don't know us,
right?
If you know us, you should call us. But if you don't know us, you jump on Google, you internet mortgage rates. The first name that pops up is Quicken Loans. You pull up Quicken Loans. I did this yesterday in front of an audience in a speaking thing I was doing. I pulled up Quicken Loans. They were advertising a VA rate of 3.49%.
And then you go down.
Yeah. And I scrolled down. That was with a 24% down payment, paying 2 points at closing with a $260,000 loan amount and a 780 credit score.
They do that with the FHA too, which makes no sense.
It's so then consumers think, and by the way, how reasonable is it to think?
Right.
Whoever on the television says that rates just dropped. You jump online. You go to arguably the nation's largest lender. You don't know to scroll. You pull up the rates and you go, holy crap! Look how low the rates are.
Right. And
then all of this confusion starts. And then when they speak to somebody who's honest, we look like shysters.
Right.
And it's just simply unfair to people that this circle is out there. And like you said, instead of celebrating that we're a 3.75, they're pissed off we're not a 3.50.
Yeah, and that's the problem, man. And then a lot of people won't take advantage of this great opportunity, thinking that it should be 0.25% lower. And actually, what's funny about this and what's ironic is that as we're watching the Fed statement, the fear was, oh my God, the rates are gonna go up because of this rate cut. It wasn't, yes, they cut the rates, so now the rates are gonna be much lower. It was the whole time that I was watching the statement, it's like, all right, that's not gonna help.
That's a problem.
That's
not
a
gonna
problem.
Help.
That's not gonna, now, luckily, Jay Powell, which is the Fed chairman, he's not the most exciting guy, he's not the most eloquent guy. He said a couple of things that helped the rates. He said a couple of things that hurt the rates. So, we're 2 days after this, and nothing has really happened from the day before they cut the rates until now. Even in the stock market has stayed pretty flat.
Yes.
So the question is, the interesting thing is are the markets going to react next week, and we're gonna see a big change, or are we gonna stay where we're at?
Well, and that brings up another point. So look. So what is the first thing we look at? The first thing we look at is the Fed's commentary. Okay. The other thing we look at,
the Fed's commentary on the economy and on inflation.
Absolutely.
Those are the two biggest things that we're paying attention to.
The other thing that we pay attention to very heavily is not what were the Fed's actions, but what were the Fed's actions in comparison to what was the market's expectations. For example, the market expected a 25 basis point drop. That's exactly what they did. If they would have dropped nothing or 50 basis points, it would have created massive movement in the market either way. If it would have dropped at 50 basis points, then the stock market would have tanked, mortgage rates would have gone down as well, that would have been great, and the opposite as well. So, because you got to understand...
where you're sitting, right?
Right, yeah, it's either good or bad. But you got to understand that whenever economic reports are coming out, particularly a Fed meeting or an unemployment or whatever, any of them, it has a lot less to do with the answer of the report or the Fed meeting, and everything to do with the comparison of that versus expectation. So in this case, we were expecting a 25 basis point drop. The markets had kind of priced that into the market.
Right.
And that's exactly what we got. So because of that, we expected it, we got it, we're not that excited.
Well, we expected it, we got it, and in the end, Jay Powell didn't say anything super exciting, anything that was he didn't say we're going to jump in and cut every time. He didn't say either we're never going to cut again. He said, look, if the data says so, we might go in, but we're very much day by day. We're very data driven. So again, it was super boring. Mm-hmm. It was a waste of time to watch that for me,
but good
because
knowledge.
Nothing happened. And at the end of the day, again, nothing happened. We still have low rates, not 0.25% lower, but we still have low rates. And look, for the realtors watching there, I think it's so important for you to understand this. It's important for you to understand that when the Fed cuts the rates, just like when the Fed hikes the rates, that doesn't have a direct effect to the mortgage interest rates, because you put that expectation in the clients. And it's so important that you set the clients up for success, and you set the clients up to take advantage of the position where we're in right now. because we're in a great position,
and
especially compared to last year. I mean, we were locking people into 5%.
And look, let's talk about something else that is another big source of confusion out there. For the average person, based on average loan amount and average down payment and average, a 0.25% drop in rate, which didn't happen, but if it did,
right,
is $31 a month.
Yeah.
So let's be honest, okay? 2 points on that. One, every person watching comfortably pisses away $31 a month.
Yes.
They don't even know where.
Unfortunately, yeah.
Secondly, okay, if $31 a month is make or break, you're making a bad decision.
Yes.
Okay, so let's understand that as well.
Yeah.
So I think this information needs to get out there in an accurate format. By the same token, I know you and I have been talking about this a lot. Home prices go up historically in a recessionary time.
Right.
So there's, I'm talking to people that are like, well, I'm going to wait for the recession to hit for the house prices to drop 50% so I can buy a house there. Yeah, it's going to be a long wait. Because that is just literally, I realize that's what happened in 2008, but that is not a normal recession. That's a collapse.
Yeah, betting on 2008, it's not a historically safe bet.
No, you're going to lose. I was sitting down with a client yesterday, and she kept saying, I'm afraid to do this, I'm afraid to do this, I'm afraid to do this. And all of the fear was paralyzing her from doing anything to improve her situation. She had a tax thing, she had a this thing, she had a that thing. There were all these things floating around out there, and look, fear is real. I'm not knocking fear, but what I'm saying is we all have a responsibility to at least you and I do, to get facts out there to try to dispel some of this fear, because fear paralyzes people and misinformation creates fear and confusion.
Yeah, and there's a lot of confusion right now. There's a lot of confusion with this rate cut, and it's just important to know where you're where you're at, especially if you're buying a house. If you're in the real estate industry, obviously us.
But how many lenders, I mean, not to interrupt you, I apologize, but how many lenders don't understand this? The overwhelming majority of mortgage professionals, to use that word, they don't really understand this. They can't speak intelligently on why interest rates stayed the same after the Fed cut rates, or why interest rates went up after the Fed cut rates, or whatever it is.
Right. Or why the statement is so important right now.
Right. So, or how inflation, like all this crap. So anyway, that's just something that I wanted to get out there. I know you did too. And I'm going to try to spread this word as much as I can to people, because it needs to be out there.
Yeah, I did a video before the Fed before the Fed went ahead and cut the rates, kind of like explaining that, because it was something that we expected. I did a video that I put out yesterday too about the same thing. And look, again, the biggest concern that I have is a lot of people are gonna move away from taking advantage of amazing rates because their expectations are set so high due to this rate cut.
Yeah.
And like you say, they're turning on the TV, they're talking to realtors, they're even talking to other mortgage people that are talking about this and are misleading people. I don't know if it's intentionally or not, but we can't we can't say that 2 days ago the mortgage rates went down. And if somebody's saying that, they don't really understand what the difference between the Fed fund rates and the actual mortgage interest rates are. And read a little bit, watch your videos, because at the end of the day, it makes sense. One thing is going to control very short-term debt. The other thing is going to control long-term debt. And if you think about it in that way, it just makes sense.
It makes a ton of sense. So look,
that's our rant for today.
Yeah,
it's just important, man. I can't stress that enough.
Leave your comments. I'm curious what everybody thinks about this. I know we got a lot of people watching right now, and go ahead and leave your comments below. Feel free to subscribe to. We each have a YouTube channel. I'm at Florida Mortgage Expert on YouTube.
I'll drop my link.
And links will be in the description below. We will come back next Friday with some more information, because there's so much to talk about.
Yeah, there's a lot changing with FHA and all that, with the way that we count the student loans. All that's changing, so that's exciting. But today was Fed week, so it was only appropriate to talk about rates. And like he's saying, man, look, when you're getting into a loan, have the conversation with your lender, have the conversation with us about what the difference would be for your overall cost of this loan with one higher rate and a lower rate. And a lot of times you'll be surprised, it makes sense to go with the higher rate and a lower cost. A lot of times it makes sense to go with the lower rate and a little bit of a higher cost.
But that consultation needs to take place, as well as putting together a customized locking strategy.
Yes.
Because more and more people, I lock everybody at application. Well, that's a shame, because I'm locking people below where I'm apping people,
Right.
because I understand what's happening. Rates are coming down, and my
Or
clients
vice
are
versa.
capitalizing.
We had a tough week last week.
Last week was a very
We
tough
had a really
week.
tough week, and to be able to get ahead of that and lock people, it's important. But
course.
same thing with the same token, before that last week, the rates were dropping and dropping and dropping. So
And our
if we would have
clients
locked
took advantage
somebody
of that.
20 days before, they would have been at a higher rate simply because we didn't go into this with a game plan.
Absolutely.
So look, rates are important. We understand that. Everybody that has gotten a mortgage understands that rates are important. But with the same token, make sure that everybody that's giving you that mortgage understand how rates work.
And look, I want to add on a totally separate direction. I'm in the process of putting together financial literacy classes for middle school students here in the area. Dr. Shaker at Polar and Dunbar Middle has allowed me to kind of host my inaugural one. So what I ask of you is this: if you have ideas on the type of information I want to spread, and look, my passion behind it is this: there is simply no financial education given to anybody, not to kids, not to adults, not to seniors. And I just woke up one day and I'm like, screw it, I'm going to do something about it. So, hey Danielle, I am, so please, I'm looking for ideas. I have ideas in my head, but I'm looking to get ideas from as many people as I can. If you have school-age children, or you remember when you went through it, or whatever, please leave your ideas in the comments below, because I am super excited to get this. My goal is to spread this throughout Lee County initially, and then we'll take it from there. So
I have a request too. I'm hiring a processor. I'm in desperate
dude,
need
he
for
really needs a
somebody.
processor.
I really need to hire
Experienced
a processor.
processors apply within.
Please, I need somebody with experience. If you know of anybody that's good, that's a good processor that has experience, please let me know. And just at least put them in the comments or something. I would love to have a conversation with them. And I'm really cool to work with. So yeah, hiring a processor.
Dick. All right, listen,
guys.
I'll see you next week, guys. Take care.